Welcome to The Explainer. Today, we're taking on a really fascinating and honestly absolutely crucial mission, protecting your hard-earned money from catastrophic market losses. Look, we all want to find the next big winner in the stock market, right? But sometimes, the real secret to building long-term wealth is just avoiding that one single stock that completely craters your entire portfolio. Okay, let's dive into this.
I want you to ask yourself a pretty direct question. Can you spot a bad stock before it crashes your portfolio? Because today, we're going to frame the everyday retail investor. Yeah, that means you and me as a financial detective. We are trying to uncover the absolute truth hidden deep inside piles of corporate paperwork. Because here's the thing. Warning signs almost always show up in a company's financial statements way before they ever make it to the mainstream news headlines.
I absolutely love this quote from the American Association of Individual Investors, mostly because it perfectly sets up our entire investigation. Think of financial statements as a corporate polygraph test. It's a lie detector. The CEO, their PR team, they're constantly going to try to spin this hyper-optimistic narrative, right? They want to position their company in the best possible light. But the cold, hard reality of the financial statements, that strips all the spin away. The numbers reveal the trends exactly as they are.
All right, Section 1, the scene of the crime, the big three statements. To be a good detective, you've got to know exactly where to look. No single document tells the whole story on its own, but when you put these three together, they hold basically all the clues you need to solve the case. So let's establish a quick baseline. The balance sheet is just a snapshot at one specific moment in time of what the company owns, its assets, and what it owes, its liabilities. Next up, the income statement. This covers a period of time, showing sales, expenses, and whether the company actually made a profit or took a loss. And finally, the cash flow statement. This strips away all the fancy accounting rules to just show the actual cash moving in and out of the business. So, the crucial point is that you need all three to get a full 360-degree view of a company's financial health.
Moving right along to clue set 1, cash flow and profitability.
Look, in business, cash is king, literally. If a company doesn't have cash, it can't pay its staff, it can't pay its creditors, and it definitely can't pay the interest on its loans, which will completely throttle the business. And here's a pro tip. The cash flow statement is way harder for executives to manipulate than the income statement. One of the most important terms you need to know here is free cash flow. Basically, it's calculated by taking the cash flow from operating activities and subtracting capital expenditures, things like spending on property or new equipment. It's the leftover cash available after the company is paid for its day-to-day ongoing operations. If you see consistently negative or declining free cash flow and there's no massive growth trend on the income statement to justify it, investigate further. It's a huge red flag that a business is overspending and just bleeding out.
Now look at the stark contrast between net income and operating cash flow. This right here is exactly where you spot the discrepancies. See, net income is basically just an accounting figure, but operating cash flow, that is the actual, tangible cash realized by the day-to-day business. If a company's net income constantly outpaces its operating cash flow, management might actually be using aggressive accounting, kind of like a cheap magic trick to fake their profitability. They could be messing with how they recognize revenue or severely understating bad debts. And that raises some really serious questions about their true financial health.
We also really need to keep an eagle eye on profit margins. If you start seeing a trend of shrinking margins over, say, 3 consecutive periods, that is a massive red flag. Narrowing margins basically mean the company is losing its pricing power, maybe due to tough competitive pressures, maybe weaker customer demand, or they're just failing to manage their own internal overhead costs compared to their peers. And man, if revenues are declining at the exact same time those margins are shrinking, that company is in serious trouble.
Let's move to and see how this builds into clue set 2, liquidity and debt traps.
Now we're shifting our investigation over to the balance sheet to see how companies can literally suffocate under the weight of their own obligations. Think of liquidity as the check engine light of a company. It refers to a company's ability to meet its short-term obligations using its short-term liquid assets. Weak liquidity is so often the very first domino to fall right before a company enters a fatal downward spiral, particularly when credit conditions tighten up or the broader economy faces a downturn.
When it comes to liquidity, 1.0 is the magic number. It's an incredibly powerful rule of thumb. If a company's current ratio, or its slightly more strict counterpart, the quick ratio, drops below 1.0, it is a glaring, flashing warning sign. It literally means the company cannot pay its immediate bills with its short-term assets.
To survive, they're going to have to rely on delaying payments to their suppliers, securing really expensive new short-term debt, or totally liquidating their inventory at a major loss.
We also have to watch out for the creeping danger of, well, creeping leverage. This happens when a company takes on more and more debt relative to its actual shareholders' equity. Now, to be fair, if a company is financing massive growth, some debt is totally fine. But if you start seeing a rising debt-to-equity ratio combined with stagnant or even falling revenue, that company is walking blindly into a completely unsustainable debt spiral.
All right, here is another vital cheat code for you as a financial detective, 1.8. This relates to the Altman Z-score. It's a formula that uses 5 different indicators to assess financial distress. It was actually developed by Edward Altman way back in the 1960s, which just proves that classic financial detective work absolutely still holds up today. If a company's Altman Z-score falls below 1.8, the data is signaling a dangerously high risk that the company will face bankruptcy or at least severe financial distress within the next 2 years.
Which brings us to the verdict, your financial detective toolkit. So we've diagnosed the major problems, right? Now it's time to shift gears and empower you with a consolidated toolkit that you can use right away, long before your portfolio ever takes a hit. And this brilliantly illustrates how you can instantly spot fundamental weakness. Keep these metrics handy. A quick ratio below 1.0, that means no short-term liquidity buffer. An interest coverage ratio near or below 1.0, the company is barely earning enough to cover the interest on its debt, meaning any tiny dip in earnings puts them straight into default. And that Altman Z-score below 1.8, huge bankruptcy risk within 2 years. Just checking these 3 metrics alone can save you a world of pain. Okay, so where do you actually find all this juicy information? You're going to want to pull up the company's annual 10K report and SEC filings. In particular, hone in on the section called MD&A. That stands for Management's Discussion and Analysis. Guys, this section is an absolute goldmine. It's almost like an industry secret hiding in plain sight. Why? Because the SEC literally requires management to disclose known trends, events, or uncertainties that could impact the company. It helps you see the actual risks directly through the eyes of the management team themselves.
Beyond the raw math, you've got to keep an eye out for these qualitative smoking guns. If a company frequently restates its earnings, that basically means their past math was wrong, or maybe even deliberately deceptive. Sudden management turnover is another one, especially if a CFO abruptly leaves to, quote-unquote, spend more time with their family. That is a glaring red flag. And if an independent auditor issues a going concern warning, listen to them. They are bluntly telling you they seriously doubt the company can even survive the next 12 months.
You know, it is so tempting to downplay red flags, especially if you really like a company's product or you've bought into their CEO's grand vision. But as an empowered investor, you must assume that company-specific problems in the data are very real. You have to prioritize financial reality over executive optimism, because at the end of the day, the numbers never lie. Trust the data, not the PR. Well, we've covered a ton of ground today, and you are now armed with the actual tools to protect your investments. So I'm going to leave you with this somewhat provocative question. Now that you have the toolkit, which stock in your portfolio will you investigate first? Go ahead, pull up their balance sheet, check those cash flows, and see what the data is really telling you. Thanks so much for joining me on this explainer. And hey, happy sleuthing.